Hey, before we get started, I want to talk to you a little bit about our theme for this quarter, growing and protecting your portfolio. We're excited about various topics centered around this, but it really comes down to three concepts that will help you grow and protect your portfolio. You can find a PDF on our website about this. Go to wiserinvestor.com, scroll down to the bottom, enter your email address, and you'll get the PDF titled 3 Ways to Grow and Protect Your Portfolio. Thanks for listening. Welcome to a Wiser Retirement Podcast, where we cover financial topics such as retirement planning, tax planning, portfolio management, insurance, and estate planning, so you too can have a wiser retirement. I'm your host, Casey Smith. Guiding you to financial success are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey.
How's it going?
It's going great. We're in our remodeled studio, and we got new podcast equipment. I mean, the best of the best.
Real deal.
We're trending. All kinds of downloads. Congratulations, guys.
You know, someday we're going to have requests for an audience.
The podcast live with a live audience.
Yes.
Like I Love Lucy back in the day.
Back in the day. But this will be the day.
Yes, right. I don't think that's going to happen.
You never know.
Never know. All right. So today's topic is we're talking about the ETF selection process. And that sounds really boring, but we get really excited about it.
That's what we do.
You know,
if you can't get excited about what you do, find something else.
That's right. You know, we're going through a great time at Wiser. A friend of mine said if we're not breaking processes, we're not growing, right? And we seem to be breaking our own processes on a daily basis. In fact, yesterday we had to spend a whole day rewriting certain processes internally. Just because we're adding so many new families to the firm, and we have to be able to make sure we maintain the same quality we always have, which I think we're doing. But what's interesting is, you know, the portfolios and how we invest stay the same. And I don't want to say they will always stay the same. We're indexers. We like index funds. Right now, that's ETFs. Back in the day, it was Vanguard mutual funds. In the future, it might be direct indexing. I don't know. We'll see how that evolves.
Well, it brings up a good point that will always evolve with the marketplace.
Absolutely.
And bringing the best of all the investment opportunities to our clients to meet their needs and of their objectives for investing.
So I see all the portfolios that come in, and it's amazing to me how many firms just don't know how to adapt and change and think beyond like 1980. I mean, it's continually like all mutual fund portfolios coming in.
Unless you have a client coming directly from a DIY, like a Vanguard, a lot of times broker dealers are seeing mostly mutual fund, high cost mutual fund portfolios.
Yeah. Mostly A shares. So they're paying 4.25%, be at the low end probably, just to get into the fund. And then the fund manager or the advisor probably at some point is going to do some swapping out, move from one fund to another fund to pay another 4.25%.
Well, each one of these firms that we're talking about, they have select lists. And these mutual fund companies are on these lists for a reason. Not just because they have performance and everything else that all mutual funds have. It's because that revenue is being shared between the fund company and the platform, the custodian, the brokerage firm, in order to be on. So it's just like you're going to the grocery store and you see cornflakes prominently displayed. Well, Kellogg's has paid that grocery firm to put that there in a prominent location. It's the same thing with the mutual fund industry, paying brokerage firms and other custodians to have their products on that platform.
Yeah, a lot of times it's not even proprietary funds of that broker. It's just well-known names, and a lot of times it's the same 4 or 5 that you see.
There is a large firm that makes sense of investing. You follow their advertisements. They got in trouble for using mostly American funds inside their portfolios, and I remember they listed out all the kickbacks in the government's lawsuit, right? And it's like yachts. I mean, not buying yachts for them, but extravagant trips on yachts and crazy stuff that you're like, my gosh, I didn't know that was even happening. I mean, you kind of think there's some kickbacks, but nothing like that, right? And to fix it, the firm didn't stop doing their practices. They just put on the bottom of their statements that there might be a conflict of interest.
Just disclose it.
just added the disclosure. And the disclosures have gotten so long now that no one even pays attention to it. I mean, look, I have to admit to myself that if you showed me a disclosure, oh yeah, here's our disclosures, and it's fine print, it's 20 pages deep.
It is like 4-point type. You need a magnifying glass just to find it.
I would just be like, forget it. Anyway, so yeah, again, if you haven't been listening to our podcast up to this point, an ETF is fairly straightforward. Matthews, you want to describe an ETF?
Yeah, well, the first ETF I think was SPY in '93, I believe. So they've actually only been started to use since probably the 2000s. So a lot newer than a mutual fund, but it's kind of the same premise in that it's a basket of securities. However, it trades on the exchange daily, and it's a lot more tax efficient than mutual funds because it doesn't distribute capital gains in December. But one of the biggest things is it's just a significantly lower cost because it's on a passive index. So that's why we believe in using portfolios of ETFs, because they're a lot more tax efficient, they're a lot more lower cost, but then you can still diversify by using various ETFs over various asset classes.
And there's a lot more transparency. You understand what's inside the basket, so it's not really hidden where you find out once a quarter. In fact, you can see flows right now. I've got in front of me this is just for the first 25 days of the new year, but year to date. We have mostly fund inflows into Vanguard's total stock market index. People feeling positive, I guess, about the markets. Foreign Vanguard's VEA ETF fund flows that are headed there, as well as the financial sector. Gold, more defensive play, I guess. And then there's a lot of value being purchased right now. You see that in the fund flows. And you can see that you go to ETF.com and click on screener fund flows, and it'll show you where all the money's going. It also shows you the money that's coming out. So a lot of sells of the S&P 500, a lot of sales of the NASDAQ. Rising interest rates may not be good for some tech firms, so the people are getting nervous about that. And then obviously long-term bonds being sold off in small cap stocks as well. Is some growth is being sold. But I don't know. I mean, it's kind of neat to see that and understand where things are going, or on a really bad trading day to see where the money went. Sometimes it goes to bonds. Sometimes it goes to stock. Sometimes it just goes nowhere, which means it went to cash and people are just sitting on the sidelines. Not that we want to use that to make any decisions, any investment decisions whatsoever. It just helps you understand why things are happening the way they do, so you can describe it better to people who don't follow this on an everyday basis.
Well, as professional investment managers, we're looking at all sorts of data points on a regular basis and utilizing that in our decision making. And sometimes the decision is to hold pat, stand as we are. Sometimes it's to make changes. But the data points are as many as you can ever possibly want to learn about the market, investor behavior, the economy, and things of that nature. Now we have a big data point coming up here in a day or so when the Federal Reserve meets, and kind of sets the table for the rest of the year as to how they see interest rates moving. So, these are data points along the way that investors use, and investment managers like ourselves use on a regular basis.
But we use them for long-term investing too. So
Absolutely.
like we mentioned, a lot of this is going to be short-term. What you see on TV is short-term, and you don't make rash decisions. You need to focus on the long-term.
Mm-hmm. It's really the growth of ETFs that has been fascinating to watch. And as a data point, for example, back in 2011, there was approximately $1 trillion invested in ETFs. As of 2021, there's over $7 trillion invested in ETFs. The number of ETFs out there for investors to choose from today is like 2,200 different ETFs that investors have available to them to choose to fit their investment portfolios and to achieve their different objectives. So there's a lot of variety out there. There's a lot of different ways that investors can slice and dice the marketplace and choose to invest their money. As an ETF investment firm, Ourselves, as you said, we're looking at transparency, we're looking at low cost, we're looking at asset classes, and utilizing ETFs in that manner in order to construct portfolios. This is something that, we were talking about mutual funds. We also don't really see professionally constructed portfolios come across when people transfer in their accounts. Our portfolios are designed to match a financial plan that has a certain required rate of return for the investors to achieve their financial goals.
Yeah, there needs to be a plan for your portfolio. It's not just transactional buying of various ETFs because they look like they're going to perform well.
Right.
Well, it goes. The ETF industry has evolved. So when we first started building all ETF portfolios in 2004, the idea was, okay, we'll use these broad-based ETFs for accounts less than a certain amount. And typically that was less than $100,000. But that evolved very quickly to where we realized that core ETF models can outperform a lot of more active strategies. And then then we started realizing that ETFs can allow firms to scale. And so for our firm, it allowed us to continue to service high net worth individuals, but it also allowed us to start working with the next generation, and give them very professionally constructed portfolios. And so we still do that today, which is amazing because, an account with, 3 million isn't managed that much different than an account with 500,000 from a portfolio construction standpoint. An account with, 10,000 can be built to mimic an account that has 3 million. And so you can scale, you can build models that allow us to scale that across all the client base, and allows firms to manage, if they choose so, to manage more efficiently, but also manage fairly. Because you don't want a situation where only the best clients at the firm get the best portfolios. And so through technology and ETFs, you're able to merge those two together. That, Brad, when you go and trade inside the portfolio, you're trading for every single person. Every single person gets the exact same price at the exact same time, no matter how big or small you are in the firm. And that's part of the fiduciary standard, is that everyone has to move through the door together, not single file. And it didn't used to be that way. I mean, I remember way back, having to rebalance portfolios, and you had to mainly go rebalance the portfolio. It wasn't, especially at smaller shops.
And as you were doing it one by one, that meant that clients who were the first in line got price A.
Exactly.
And clients who were at the end of the line were getting A minus or whatever the case may be, based upon the trading pattern that occurred throughout that period.
That's right. And so that's something that typically would be reserved for very large firms. The Dean Witters back in the day, and the Merrill Lynches, right? But now that this done, even the smallest single shop advisor should be able to do that. And it's partially because of new software technology that is relatively cheap now, and then also because of exchange traded funds being able to grasp such a big section of the market.
Right. And everybody, regardless of account size, as long as they're invested in the same securities, which, as you said, we can scale up and down now, are getting the same return numbers and the same performance as each other. So yeah, it's very, very healthy and very, very beneficial to investors.
So another advantage to ETFs is being able to segment out like a theory that you have, or a hypothesis of where you think the market's going to be going forward. And so if you want to buy just airline stocks, you can buy an airline ETF. If you want to buy only U.S. banks, you can buy an ETF that has U.S. banks. I mean, I even saw an ETF advertised recently that was like private equity move. So whatever private equity was going to be doing, they try to get ahead of that, or they're falling right behind.
There's an IPO one now because IPOs have gotten so big too. There's a SPAC ETF because those were starting to become a big deal that tracks back. Well,
it's really the evolution of the ETF industry, as Matthew's mentioned, back in 1993 when SPY came out, which was the replication of the S&P 500, which is a very broad base of 500 companies, extremely passively managed over the years, now to being more specific and being able to slice and dice the marketplace, creating an index and following and mimicking that index through its replication technique. So as you mentioned, airlines, okay? It has a catchy name. One referred to as jets, right? So
Right.
it's kind of, I think that was just kind of interesting that they took advantage of that. But what they're doing is investing in all the airline stocks rather than just a single airline company itself. It's very difficult for a company to, if they're in an industry or sector that is in a downswing, okay, that's not favored by the market and our investors, to do well. And yet the opposite is true, where in an industry or sector that is doing well, that there still may be companies that are doing poorly within that. To be able to select within that industry or in that sector is very difficult for investors because they just don't have access to the complete information that Wall Street has. An ETF, by selecting an ETF, which we're going to get into, but by doing so, selecting the entire industry and participating in the growth of that industry or sector, is a great way for investors to put forth their money into their hypothesis, into their ideas for where they think investment, growth may happen in the future.
You were talking about the Jets. I wrote a blog about that last year. It was against Warren Buffett, the Oracle Omaha. He was saying go away from airlines, and actually retail investors flooded the Jets ETF when it worked out for them. So you just never know. If you see, like you said, the hypothesis is what you think, rather than have to buy each individual company, you can kind of buy the industry as a whole.
Right.
Well, technology is one of those sectors that you can focus on, and it's gotten off to a little rough start here in 2022. But nevertheless, we are pretty good about ignoring the short-term volatility for long-term gain here, and I think that's you can't convince me that technology is not a big part of our future for the next decade. But there's different types of technology funds getting different types of exposure. And so what we want to do today is just kind of walk our listeners through the ETF selection process. And we have a couple of tools that you can use for free. I was on the grassroots start of all this movement. It used to be called Index Universe. Now it's called ETF.com. And it was a fun journey back in 08, 09. But I think most of the creators have moved on to Grayscale, Bitcoin, and there's new management there. I don't know them as well or at all actually, but I still don't mind plugging the website. It has good content. But you can go to ETF.com. You just click on Screener, and you can screen by so many different segments. I was just kind of, while you guys were talking, I was kind of just browsing through this. There's ETFs, they're just U.S. insurance ETFs. There's just internet-only ETFs. There's low-carbon ETFs. There's master limited partnership ETFs. I mean, there's 2,200 ETFs out there, and this screener has every single one of them. And not all of them are going to be followed, but the legitimate ones, I'd say, are followed at this point. But when you screen for U.S. information technology, so we're going to avoid foreign right now, but U.S. information technology ETFs, you actually end up with 20 results. So there are 20, actually, the screen is for 20 on the page. There's 18 ETFs. There's 18 ETFs inside the technology space. How in the world do I choose the right one for me? Now, there's a couple here you can just eliminate very easily. If you want to sort by expenses, man, it goes from 8 basis points or 0.08% of 8%, all the way up to 1.11% for the HCM Defender 100 Index. Sounds
catchy name.
Sounds very, very big, but it only has $358 million in assets. So I would buy that one. Howard Capital Management. I've never heard of those guys. Hopefully they're not listening. Just insulted them. But yeah, if you look at the top of the list, just based off of fees, Fidelity, Vanguard, State Street, BlackRock, Invesco, those are all reputable companies or sponsors,
Right.
that you can go play with. You're not worried about funds being shut down. They're reputable companies. And so that's one way that you can screen is by, okay, we're not going to put anything that we're worried about shutting down, ETF shutting down, right? Individual person, I mean, it could be a headache. If we had to deal with that, that'd be an absolute nightmare if an ETF was liquidating. I will say, though, historically, when ETFs have liquidated thus far, they've all done it very efficiently. And I don't think there was much angst in getting out of the funds, because ETF trades like stock, right? So every case that I have known of an ETF shutting down, trading was very efficient, because you can just go to the market and sell it, and there's an AP in the background who's gobbling up those shares and throwing the shares out as you're liquidating. All right, so Brad, you want to talk a little bit about your screen? So you
Sure.
did your own screen before the screen. I'm doing my screen live, making it real.
Well, sure. And the idea being is that as an investor and an asset manager ourselves, we're going to look at certain things that we think are important. Okay. And those are going to be our major factors. And once you so it's like peeling back layers of the onion. Once they make it through that screen, you have another set of screens to look through and to make sure that you're getting the best ETF. And best is going to be, defined differently for different circumstances, but I'm just going to use that word, the best ETF for our circumstance and for our clients. The first thing you want to look at is, what is the underlying index?
Yeah.
Just because it says it's a technology ETF doesn't mean the index is an index of technology that you're planning on investing in. So in the 4 ETFs that I've chosen in this field, I have different indexes for each one. Okay. Which means that they're all trying to differentiate themselves slightly differently so that, investors can choose them. Okay. They don't want to be ubiquitous. Okay? So Vanguard, BlackRock, Spiders, and Fidelity all have high quality technology oriented ETFs. And they're all following slightly different indexes, which if you follow a different index, you're going to get a different result, quite frankly. Each firm has different fee schedules, ranging from, I think, Casey, you mentioned 0.08%. In this case, the 4 that I mentioned, up to 0.43%. How much are you willing to pay for what you're investing in? The size of an ETF is very important. It gives an indication of the daily volume and the number of investors out there willing to buy and sell at any given time. For an ETF that has a limited amount of assets under management, it also means it has a limited marketplace of investors willing to buy and sell from you at any time during the day. So you want one that's large, well established. And in these different indexes, there's different numbers of securities as well. Some of them are rather tight in their range, I'll say. The Technology Select Sector Spider ETF Fund, symbol XLK, tracks an index of the S&P 500 technology stocks. So it's only the technology stocks in the S&P 500, which is about 75. So it has a diversification of 75 different companies, whereas Vanguard's information technology, symbol VGT, is tracking a much broader index of information technology companies of different market cap sizes. It has 362 different companies in it. So with that greater diversity, you're simply going to have a different range of returns and expectations. And these are all different considerations that we use in order to make a selection for our portfolios. So we're looking at the index, we're looking at the size, we're looking at the number of securities, we're looking at the cost, and we're also looking at the expected return, which gets into a whole nother podcast.
Right, because a lot of times you see in 401ks, people pick the fund with the highest return, and there's a lot more that goes into it than picking the highest return.
There is. And quite frankly, there just is.
Well, it's also the exposure. So again, what is that index made up of? So for instance, VGT, well, you talked about, was it XLK? Was it
XLK is the spider. Yeah.
Yeah. Okay. So Apple is 23%, call it 24% of that index. Then there's Microsoft at 20. So that's 44% of your money is inside two companies.
Right.
Partially because the base that it's pulling from is very small, where VGT, you still have a large holding of, because Vanguard's all about cap weighting, right? But VGT, 22% in Apple, 17% in Microsoft. NVIDIA's 5%, Visa's 2%, MasterCard's 2%. After that, it gets pretty small on the weightings, but the top 10 holdings cover 59% of the portfolio. So you have, which is Vanguard's really good at this, you have 362 holdings inside that account, but it's still that top 10 is a major concentration. Also, I believe VGT carries some mid cap in it, some very small cap, where that would tell me that I'd probably take on a little more volatility in VGT than I would in XLK, right? Because anytime you add a small cap or you add mid cap, you're gonna have slightly more volatility. In this case, it's a very small percentage, but that's something that I would look at is what's the cap size.
In each one of these ETFs, and that's generally this case in the industry, is that they're capping sector amounts and weights of individual companies at the same time. And this one has a 25-50 cap weighting, 25% at any sector, and 50% at any issuer, I believe.
Yeah.
So,
and every one of the choices on your sheet there, every one of those are mostly large cap in information technology for the U.S.
Right. Now, in VGT, the Vanguard, it excludes telecoms. So it's made the decision that it wants to be a pure technology fund, excluding the telecom application. Now, Fidelity's information technology fund follows the same index, but includes telecoms. So it's differentiated itself in that manner.
Yep. Yeah, and again, as I'm going through these, there's a lot of similarities across. It's just when it gets into the details, that's where you start seeing some of the slippage. For instance, IYW's 57% software and it's 21% semiconductors, where XLK, the weighting's a little different. 46 software, 23 computers, and then 22% semiconductors. And then VGT, 47, 22, 20, same asset classes, right?
Right. And so as a professional asset manager, we're digging down all the way through these different data points in order to select an ETF for the portfolio, because we're selecting it as part of other, investments that are in the portfolio, knowing that they have, investments in this sector as well. So we're not necessarily trying to double up, but we're trying to enhance the technology selections in an entire portfolio. And we're looking at these different ETFs for different circumstances.
And then obviously, each one's going to perform a little differently because of these different weightings. So you have technology, but then you have these subsectors inside that. And that's the part that I don't like getting into. I don't like placing bets. I want to know what the highest probability of success is, and I want to follow that, right? The path of least resistance
to success.
So, yes, because the reality is that from our standpoint, people hire us to maintain their wealth or to build wealth. No one's coming here and saying, I need double-digit returns every year, regardless of what the market does. We have to place these really big bets and hope that we win. That's not what we do. That's dangerous because statistically, we're going to lose. We're good enough. We can probably hit some home runs along the way, but the home runs aren't going to be enough to overcome the reversion back to the average, right? So that's why we like the ETFs, being able to capture the rate of return that you need to maintain your lifestyle, to keep up with inflation and purchasing power.
Reaching your goals. I mean, we want to beat
Yeah.
benchmarks, but it's rather reaching your goals than trying to outperform everybody else.
Correct. Yeah. So anyway, it's reason I like VGT is because you have that broad exposure to the asset class. You have the most holdings in VGT than you do the other ETFs. So I know that there's not one company that's really going to wreck me, because you could argue if Apple or Microsoft get wrecked, it doesn't matter what you're in, right? The whole market's coming down with them because there's such a big component of the S&P, right? Now, something that we can transition into, but something I like to look at when selecting an ETF is its tradability. Because if we're going to go place a trade for 100,000 shares, I want to know that we can actually execute that. Now we have tricks of the trade that we can execute almost on any ETF. We just have to contact the AP and be able to let them know that we're about to place this trade, and they can create the shares to then turn over to us.
Right.
But for those people at home, they are DIYers. It's not, you don't have access to that. So what you're going to have to do is make sure you're always using limit orders when you're trading ETFs. Do not put a market order in for an ETF ever. And it's really simple. So let's say you're buying 10,000 shares of something, and the current market price is $50 a share. But at $50 a share, there may only be 2,000 shares at 50. And the next market price is going to be $50.10, right? For another 2,000 shares. And then the next 2,000 shares or 5,000 shares might be $50.45. So when you do your market order, you're going to get that first 2,000 shares filled at 50, and you're thinking that's great. Well, then what it's going to do is start climbing up the price ladder to fulfill your market order. So you have no protection whatsoever. So what you would do typically is you would place your trade, and then you put a limit order 1 cent above the market order, because we got to pay for that Wall Street Ferrari and big boats, right? On Long Island, right? They make a penny. They get a penny every trade. This is what's going to happen. So give them their penny, limit order 1 cent above the market order, and that is a great place to start. You may have to adjust a little bit depending, because you have to remember that the ETF itself may have a price. It does have a price, but it also, the basket of what's inside the ETF also has its value. So in the S&P 500, there's the value of all those 500 securities in there. And then there's the value of the ETF itself. Those are two separate things. So
those are referred to as the premium or the discount.
Correct.
Relative to the NAV, net asset value.
That's correct.
Right.
And there's whole private equity funds or hedge funds out there that
Yes.
take advantage and arbitrage if something gets too lopsided.
Right.
So the market is very efficient in that front. But there are some funds out there that don't trade that efficiently, and you just can't go putting in market orders. You have to protect yourself.
And often these are the funds with the lower asset values, assets under management.
The lower
Because
asset values, or the smaller players who don't have access to the Knights trading of the world, or they're not on their top priority list.
Mm-hmm.
And I've seen it. I've seen some really cool concepts over the years going, man, I would invest that. We've had those companies inside our portfolios in the 21 years we've been doing this. And the larger our firm got, the harder it was to execute the trades. And eventually you're like, man, forget about this. I'm just going to move back to the standard, which would be Vanguard, State Street, BlackRock, because they have the ability to get me what I need when I want to trade it.
Right. Right.
And then I'm talking to the sales rep at these other companies. Oh no, we can get this for you. Call this number. And you call it, no, it's just not the same. But again, we're talking about fractions of a penny in some cases, which we fight hard for. We fight hard for every fraction of a penny, because, $230 million that we manage here, that's
it adds up. That's what we're paid for.
It does. Absolutely.
To get the best price, best execution on every trade.
And it's not all us. We have to depend on TD Ameritrade or Schwab to be able to assist us in making sure we're getting the best execution on that side as well. But that is something that's important. In fact, on ETF.com, if you can search any ETF there. You go to ETF.com / and type in the ticker. So you go ETF.com / IVV. and then you'll go right into the IVV screenshot, and you'll see tradability. So you'll see the premium and discount. So for instance, on the S&P 500, I mean, that's a very efficiently traded fund. It's very tight. The scale makes it look like it's very volatile, but the scale is so tiny that if they zoomed out, it would be a straight line. Where, and I don't want to pick on any particular company necessarily, but if you would have put in a different company, not a Vanguard fund or BlackRock or State Street fund, that's not always the case, especially if you get into these, I call them marketing ETFs. They're really great for marketing, because marketing is all about selling to people's fears, right? So,
well, they're marketing a story every time they come through the door and want to tell us a new story about a new investment strategy that they've done the back testing on. Of course, you've never seen a back tested fund that was poor.
No, it's never happened.
It's never happened.
Or if it did,
they just tested them
never launched
and threw them away.
Yes, exactly.
Add a catchy name to it.
I remember when BP had that. It was BP, right? It had that the Gulf oil spill.
Mm-hmm.
So I remember BP had the oil spill. So oil stocks show up a lot in high yield bond funds, and I kid you not, like shortly after the spill, someone comes running through here, trying to say we have a high yield bond fund X oil. I'm like, I'm pretty sure they'll clean the spill up eventually, and I'm pretty sure that this fund is going to be defunct because people want the high yield from the oil because people pretty much need oil these days, right? There's always something out there that they're creating to market to people, and it's the same way to advisors, and it's amazing how many advisors I feel like go for it. How many advisors go, oh yeah, we're really worried about that, and it goes back to sticking to the core. Stay to the core. S&P 500. Like for instance, this year we talked about at the beginning what value is supposed to outperform growth. Foreign is supposed to outperform the U.S. That's a little different. That's core versus core, but do both. Own both. Because when the pendulum swings, you're busy working, and you're not going to notice one day that value all of a sudden is the place to be.
What's the whole point of diversification? One's going to perform better than the other, or else it's not diversified.
Right. Exactly. But yeah, so I guess the takeaway here is pay attention to name brand, right?
Right.
The cornflakes that you referenced earlier, the ones made by Kellogg's and the one made by Publix, they say, the Publix ones are the same. In this case, they're not the same.
They're not the same.
You want to stick with the name brand wrappers. Second thing is cost is very important. We talk about that all the time on our podcast. You have to maintain low cost in order to beat the active managers over a long time period. So that is important. Our portfolios are basically nearly free these days, and the average cost is 0.05% across all of our funds that we use. Next thing is tradability, or I guess understanding the methodology of the index.
The index itself that is tracking.
I used to always say you have to learn how the stock got there. So you look at the holdings, that's great. How did it get there? And in this case, for XLK, that follows which index is that?
That follows the S&P 500 technology stocks.
There you go. So you go to S&P 500 technology index, just Google that methodology, and a PDF will most likely pop up. You can download it. It's going to be several pages, and you can read about how it gets inside the portfolio. And then from there, I'll look at rate of return and standard deviation. No one ever looks at standard deviation. That's the volatility. That's the deviation from the average, right?
Right. And from the expected average going forward, which is your standard deviation. And you're referring to that because nobody worries about that in an up market. They only worry about that in a down market.
Exactly.
But we worry about it because we're trying to guard against severe price depression in portfolios.
And understanding, I got this fund got a higher rate of return, but did I take twice the risk? And it's okay to take twice the risk, but you have to be comfortable with the ride.
That's right. You have to know it.
Yep. Mm-hmm. And understand what's happening. And then from there, I would roll into probably, building a model how you think it would look and then back testing that model to see if it's behaving the way you think it would have behaved
Right.
inside the portfolio. And then there's the forward thinking, which is the hardest part. Is this something that I want to be in my portfolio, not for this year, not for next year, but for the next 5 to 10 years? You shouldn't make an investment that you don't think that you're going to be holding for 5 to 10 years. Right?
That's very true, because you can start building your position with small amounts, and then over time, as you see the hypothesis coming to fruition, you can continue to add to that position and pick up that momentum of that growth. So, but it's being there and studying and watching and being ready for it. That's important. If you think you're going to have your own hypothesis, you don't necessarily have to go all in at 100%.
True. That's a good point. But
you would still be investing long term, though, like you mentioned. Anything short term's a little more speculative. It's not investing.
Yeah, true. But I guess my pause is what I see a lot is, hey, I read this article about, I don't know, name emerging market country, India. and this said the India economy is going to heat up. And so I bought an India ETF, which I don't think they allow foreign investment. So it'd have to be replicated somehow. So that was a bad example. But
a big one was China a few months ago when that was starting to crumble.
That's true.
You get a lot of calls about that, and it was all over the news about how emerging markets were struggling because of its China's big positioning in most ETFs there.
So let's stick with the India example. So you buy an India only ETF and you put 1% of your money in it. So the point is that you got to have conviction too. Like if you really think that this is something that's going to do well, 1%, it's not going to make it or break you. I mean, you'd have to have like a 4,000% rate of return on a 1% allocation to really move the overall average needle, right? So I think that's something that we see. I wouldn't say a lot, but we see people dabble. It's like 1 or 2% here. If you're that convicted about emerging markets, it should be 10+% of your portfolio, right? So that's something that you have to pay attention to. Is that, am I adding something? Because it's almost like window dressing. If you're going to add something in a really small percentage. Now, positions can get diluted because it might be 10% of an all stock portfolio, but then then you average in bonds, it ends up being a smaller percentage. That's a little bit different because you're managing your risk back and forth. But I don't know. I feel like you have to have conviction too when you're choosing an ETF. But anyway, that's why I like the VTI. That was my pick of 2020 or 2021. Right?
2021. That's right. You did. Yeah, you were the winner.
My pick for this year is not going so well. So we need
one month in.
Well, yeah, 1 month in. Can I double down? Is that a thing?
Go for it.
Can you double down?
Sure.
How does that work exactly? All right, guys, good conversation. We'll talk to you next time.
Thank you.
Great.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.